Hi, I'm Midas of Midas Investing. Today we're going to be taking a look at Generac Holdings, ticker GNRC. This company got quite a lot of excitement and quite a lot of attention in the run up of the bull market of 2020 and 2021, and has also gotten a decent amount of attention with its subsequent major declines here in 2022 and 2023. With it at much lower levels, we've been very excited to take a look at this company because we think it fits in really well with some of the themes that we're very interested in on this channel, including both grid electrification as well as a maturing population here in the United States. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. Hopping right into their 10K, wanted to discuss exactly the section where they themselves discuss their place in what they see as some key mega trends going on here in the United States as well as globally. In particular, they talk about the transformation towards a grid 2.0, evolution of the traditional electrical utility model as we adjust towards supply and demand imbalances that currently exist, while shifting towards more renewable energy types. They discuss also the impact of climate change and the products that they serve, giving an option for creating a little bit more stability in a more severe and volatile weather environment. They talk about natural gas as an important transition fuel to the future, obviously with a more shift towards electrification and moving away from fossil fuels. You can't necessarily break the usage of them immediately, and natural gas is seen by many as a good transition fuel, and natural gas is the fuel for the generators that Generac produces. There's been large amount of discussions socially and politically about the needs for a huge revamping of infrastructure, which we kind of talk about a little bit in relation to the grid itself and its needs of revamping towards electrification. But they themselves also have a large focus on the telecommunication infrastructure, because in particular, that includes a lot of grids and a lot of networks that have to be maintain a strong power solution consistently, which means you got to have backup solutions, and that's where Generac comes in. And then obviously in the last few years, there's been a huge shift towards using one's home as a sanctuary, a lot of working from home, stuff like that. Obviously, we've seen a little bit of a shift away from that in the more recent couple of years as well. But at the same time, there is still generally a little bit more of seclusion in society. So you're going to need backup solutions for your home as well. They actually go into further detail about some of these issues, including the power quality issues, and give some more details about some of the expectations in regards to the quality issues that we experience here in the United States. They also talk about the overall penetration of their products into the home standby market overall within the United States, basically showing that there's actually still lots of headroom to move upward relative to other markets. But we'll actually talk about that on a few other of the slides from their earnings presentation, as well as they talk about the different markets they're attempting to enter into outside of their more traditional home standby generators as well. And likewise, the earnings presentation that I was just mentioning also gave quite a lot of useful information. Right off the bat, we'll look at this slide here, which kind of gives a general distribution of the types of products they have, with about 60% of their revenues coming from residential products, which includes the home standby generators that we're talking about, the more large, full size stationary generators. But there's also plenty of more portable generators that they have, including also a variety of other products for maintaining your home, also including a lot of environmental products like power consumption management products, including the ecobee products that they recently acquired a year or two ago. Then they also have about 30% of their revenues coming from the commercial industrial side, which includes large standby generators for large manufacturer bases, hospitals, including a large focus on telecom, as we were talking about before, because of especially since these are backup generators that works particularly well for power systems that really do need to be online all the time, like networks and power systems. Coming down further in the presentation, I gotta say, this is one of the slides that really gets me excited about this company. They talk about their overall penetration throughout various markets throughout the United States, as you can see right here, with some of the strongest markets pushing upward into the 20 percentages. You can see that seems to be focused in particular around like Louisiana, West Virginia, Maine, and also relatively strong in Michigan and places like that, with a decent amount of strength generally throughout the eastern United States, in particular kind of focus a little bit more in the southern region and some of the more northeast regions, which kind of makes sense given some of the geographic disbursement of those locations. But what in general, they'd say that their overall US penetration is currently about 5.75%, which in the 10K, they give this information going back in all their 10Ks for a full decade. And I'm generally going to be relying on the overall growth of this penetration rate as a basis for how I'm going to build my model. But they do talk about how some of the highest penetration markets that they do have in those 15 to 20% are still highly growing. In fact, in the first quarter earnings call that I listened to just the other day, the managers were talking about how actually those are some of the highest growth rates that they have are in some of their highest penetrated markets, which is a little bit counter to what you might expect with the higher penetration. You would maybe assume that they're starting to level off in their strength there, but that would indicate that some of these higher penetrated states are perhaps some of the highest growing states. So that means that yes, there is a lower basis in some of the other states, which maybe means that that's where a large amount of opportunity is. And that might actually be a little bit of a slow roll to get those ones growing. We might see further strength in this particular region, as they talk about some of the three largest markets being California, Texas, and Florida, some of the highest populations, representing about 25% of addressable households for them, still significantly underpenetrated at 3.5%, which is pretty significant. Now, in conjunction with the penetration rates that they show dispersed across the geographies in the United States, they actually take a step back and compare the home standby generation penetration, which we were just talking about, which is this bottom line down here, comparing it to other technologies of similar kind of home technological growth related to environmental processes over the last several decades or even over the past century. In particular, comparing that to general portable generators, which you can see starting back maybe around 1960 or so, all the way up through the 2020s, has moved upward to a penetration rate in US households of close to 20%. Home US security systems moving up likewise from similar time frame up to possibly 28%. And then central air conditioning going back all the way to around 1945 has penetrated all the way up to 88%. So it can give you an idea of how these penetrations can start relatively slow, but actually still gain huge traction over time. Obviously, the case that they're trying to make is that this 5.75 has the potential to go all the way up to something like that. But even if it could just double, which would put it still below all these other penetration rates, that would make a significant amount of market opportunity. As they say right here, every 1% of increased penetration equals about 3 billion in market opportunity. Now that's based off of their own assumptions. I'll say right off the bat that based off of the model that I built, I found it to be equal closer to maybe about 2 billion in market opportunity for each 1%. But even so, 2 billion of market opportunity for 1% is pretty significant relative to their current revenue levels. And then as they talk about up here, this fits in well with some of the other themes that I've been focused on the channel beyond electrification, but also the maturation of the US households. 65% of buyers age 60 and older. Think about it like rationally. Older households are going to be more wealthy, as they mentioned here, so they're going to have more money to spend on these products, and they're also going to be less fit personally, which means that they have less options to go out and deal with a lack of power in the type of circumstances. Like they really do have a higher need for more consistent power systems, whether that's just for general living or maybe even for medical applications like certain medical devices that are going to be keeping these people living. And then they also talk about the need for replacement units over time. So the larger the penetration rate gets, the more consistent revenue you're going to be able to get over time as these products need to be replaced. And then coming down further, they talk about some of the trends in the overall baseline, the levels of outage hours that we've been seeing in the United States over the last 6 to 7 years. As you can see right here, a general upward trend, even just ignoring the major outage events, you can see somewhat of a slow upward trend, not necessarily a huge period to look at. But then there is also obviously major storm events, major outage events, or major grid events that we've slowly been having a little bit more and more of. Whether you want to blame that more on climate issues or just on the overall maturity of those grids or some combination between the two, the fact of the matter is that backup solutions are needed. As they've been expanding the dealers that they work with that sell their products, you can see that the general explosion in overall in-home consultations, which itself is a general proxy for the activations of their products. So the trend is growing. The trend is growing, and these products are slowly becoming more and more recognized as a strong solution for these problems. And then finally, we'll take a look at some of the slides that give us some more forward-looking information about what management is thinking about. I gotta say, I just really love it when I see a capital deployment slide on any of these earnings decks. That really tells you that you have management that's thinking things correctly, not only capital deployment, but setting it in terms of priorities as well. As you can see, with their top priority being organic growth, they typically do about 2.5 to 3% of general capex. Now, obviously, I use a little bit of a different methodology in terms of measuring capital expenditures, whereas I like to include an amortized level of R&D expenses. And I will say that Generac does a significant amount of R&D as well, generally about 2 to 3% of sales in that particular category as well. So, if we were judging things from my perspective, I would say that in fact they are even more focused on organic growth, and especially in a more innovative way, which is super, super important. But they also have a large focus on M&A, as I was talking about some of the companies, including like Ecobee, that uh, they've acquired over the years. They've actually made many acquisitions over the last decade, and they've shown a relatively strong level of ability in actually taking those companies and integrating them into their overall growth process. Not to mention, I think their focus on which companies to acquire has shown a particular level of intelligence and a strong focus. And then beyond that, the next priorities they mentioned being paying down debt. They state a target leverage level. They talk about the maturities that they have on the forward future, which really gives you the type of detail that is going to be important for actually getting sort of some sort of measure of where their balance sheet is actually heading over time. And then obviously after that, fourth most important, but should obviously be the last thing to focus on, being return of capital. They are focused on trying to do share repurchases. They have a significant amount authorized, a little under 300 million, but they're trying to do it a little bit more opportunistically with more focus on these other categories, which is exactly what we like to see. And then with that, they also do give us some outlook for the 2023 fiscal year with expectations of consolidated net sales down between 6 to 10%. They give some specifics on some of the subcategories, but I'm not necessarily focusing on those details for my projections. But they also give an adjusted EBITDA margin expectation of between 17 to 18%, which is approximately in line with some of their longer term averages, maybe a little bit on the higher side. As well as they mentioned conversion of adjusted net income to free cash flow well over 100%, which would be nice relative to some of the buildups of inventories that they had over previous quarters. Coming over to take a look at the revenue model that I built for Generac. Up here at the top, we start with some macro information that's going to be relevant towards building up the addressable households metric that I said I was going to be basing this off of. We start with the US population up here at the top, as well as kind of relying on the future expectations that the government has provided as far as what they expect for population to grow to over the next decade. As well as off of the Federal Reserve website, I can get a measure of the total amount of households in the United States. As I had kind of mentioned when I was talking about the penetration rate, they measure their penetration rate as a measure of the total addressable households in the United States, which they define as households over a certain amount of minimal value within the United States, which, as I said, depending on the 10K you look at, it actually gives a specific different amount of information for that. As you can see, back in 2013, it was basically any household over 100K for them. Up here in 2022, they measure it as any household over 150K. So I kind of wanted to kind of get an idea of just how many households that may or may not be including. So I also kind of took a look at the median and average home values in the United States for each of these years. So I can kind of compare that too. You can kind of see, generally speaking, that this minimum value that they mention is kind of about 2 to 3 times whatever the average or median values are, which in my opinion means that it's basically going to be including at least 75% of pretty much all of the households within there. For the most part, I'm just going to be relying on the general household number, but I kind of wanted to include this information so that there wasn't any confusion about what type of household is totally being included there. Now, below the household line, I also include the population per household, so that we can make a projection of the growth of the household. Like I said, you can get information about the expected growth of the US population. And so based off of the ratio between population per household that we've had over time, we can see that over the last decade, that itself has actually shrank from 2.8 persons per household to 2.6 persons per household, or less than 1% shrinkage per year. So relying on the growth expectations of the population, as well as that continuing trend in the populations per house, we can come up with an estimation for the total amount of households that we can expect in 2032 of being about 148 million, with about 2.4 persons per household. That's going to be kind of my basis for assuming, like I said, the amount of penetration that they can get in the future. So coming down to take a look at some of the more industry-based information, I found some industry reports giving estimates for the global generator industry of about 26 to 27 billion in 2021, as well as a global home standby generator, which is the specific subcategory that Generac is focused on. In 2022, it was about a 7 billion market, again, globally. Then I also found another industry report of US generator industry. This is now the more broad generator industry, but focused on the US in 2020, of about 4.6, 4.7 billion. As you can see, it's a little frustrating sometimes finding industry reports on different years for different subcategories of the market. But either way, since all of these were somewhat relevant to Generac, I thought I could still use this as somewhat comparable information for the future. Now, each of these reports also gave expectations of growth for each of these industries over varying periods of time, up to 2028 to 2029, or even all the way out to 2032 for some of them, which was relevant for what I wanted to. Either way, for the global generator industry, we see or according to the report, it was going to grow at just under 6% to 2029, up to about 42 billion. So based off of that, we kind of can assume that the industry itself is likely to grow at a similar basis, possibly out to about 50 billion in 2032. Likewise, we do the same process for the global home standby generators. That gets us up to about 13 billion in 2032, and then the US generator industry, that gets us up to an expectation of about 8.4 billion in 2032. Again, these are based off of just industry research reports, not my own particular assumptions. The only assumption I make here is that after 2029 to 2022, they'll continue growing at the same rate, approximately speaking. That's the only assumption I basically make there. Now, although that information is basically just to compare my end result revenues against, I wanted to get an idea of what type of market share I was theoretically comparing it to. So we'll wait until I actually walk you through the rest of the model to actually use that information to compare it to. So now below that, we do actually have the home standby generator penetration rate. As I was talking about in the 10K, they list that information going back each year. You can see back in 2013, they were down at 3% penetration rate, which is significantly lower than the current 5.75 that they had at the end of 2022. That comes up to about a 7.5% growth in that penetration rate each year over the last decade or so. So for my assumptions in the growing into the future, it's going to be based off of the growth of this penetration rate going forward. So when thinking about where the household penetration can go over time relative to some of the historical trends that we're taking a look at in the earnings deck, I tried to be very conservative about where I thought it could potentially lead up to. For my base case assumption, I'm relying on the assumption that it's basically just going to move upward by about 2%, which is less than a 50% growth from the current penetration rate, which I think is pretty conservative estimate. So that gets us up to 7.75% as a base case. For a bear case, I assume that it's going to be half as much of penetration growth, up to 6.75%. And then my bull case assumption that it's significantly even more than that, up to possibly 9.75%, which is still less than doubling of the overall penetration rate, which was would put it kind of in line with the similar growth rate that we saw over the last decade. And then obviously combining that with the total households that we're expecting in 2032, that gets us to a total households being serviced in our bear case assumption of about 10 million, our base case assumption about 11.5 million, and our bull case about 14.4 million in 2032. But when thinking about the households that are being serviced, for some of the measures, it's going to be important to have an idea of the total amount of households that are being serviced. But in terms of acquisition of revenues over time, the thing that's going to be most important is understanding how much growth in households is going to be over this period of time. So taking where the current household level is at and comparing it to with these expectations, and then dividing that by 10. So essentially just assuming it's going to be a roughly similar amount of households acquired over the 10-year period. That gets us to about 300,000 in acquisition growth per year for the bear case assumption, about 400,000 for the base case assumption, and 700,000 per year for the bull case assumptions. I did do this historically as well. I just didn't necessarily talk about it too directly, but I did take a measure of the households being serviced according to their penetration rates in this metric right here. And then I did take a 2-year average of that metric because I kind of wanted to smooth out some of the odd assumptions that are being placed in there, either by their penetration rate that they gave me or the measuring of the households that I did. So I kind of wanted to smooth out a little bit of the uncertainty in there. And then I took a measure of that change over time. As you can see, about 300,000, 400,000, 500,000, 600,000, 500,000, an average about 400,000 per year over these 7 years that we're measuring itself. So comparing that 400,000 per year acquisition against our expectations of acquisition rates, I think that it puts it relatively in a logical path. I don't think anything unreasonable about those assumptions. Then coming down here to actually take a look at the revenues of the company over the last decade, we have the total revenues, obviously, but then that is split into both domestic and then international. And then I have the domestic revenues themselves then split specifically into the residential versus the commercial and industrial, and then versus the other. I don't have the international split into those 3 subcategories because they didn't actually give find enough information for me to do that over a long enough period of time for it to be super relevant, as well as considering the major focus of the revenues being on the U.S. markets. I figured that I could build up basically from my assumptions there. Not to mention the macro assumptions that I've been talking about are also focused on U.S. data. So I'm really just trying to get the U.S. Domestic residential portion right, and then build proportionally off of that. And specifically, what we do is we take a measure of the change in the residential revenue relative to the household acquisitions that we got to get an idea of approximately how much dollars being spent per household acquired there was in each of these individual years. You can sort of think of this as like a weighted average of the price being spent on the products for each of those households. So it's not necessarily like saying this is the price per generator, because obviously they could have gotten a mix of different products or something like that, but it's effectively going to be the proxy for my pricing for these products itself, which you can see moved from somewhere in the 2000s per household range to upward into the 4000s, 5000s per household range in the most recent years, at a CAGR of about 12% per year over this time frame. For my assumptions about how that pricing is going to grow over time, I'm going to do something maybe a little bit counterintuitive to some people, but I think it makes sense, which is to say that for my bear, bull, and base case assumptions, or I might have that backwards. For my bear, base, and bull case assumptions, I'm going to have the bear case assumption actually have the highest growth rate, and my bull case assumption have the lowest growth rate, under the assumption that because under the assumption that because the bull case assumption has the highest amount of penetration into other households, that means it's likely to actually be calling far more competition to the space, and therefore bringing down the relative pricing increases relative to the bear case assumptions. The bear case assumption assumes a lower penetration rate, which in my mind assumes that Generac themselves is going to maintain probably a higher ability of pricing power relative to their competition. Either way, our bear case assumption has it growing this pricing level at approximately half the level that it grew over the previous decade. Our base case assumption having it a little bit less than that, bring it down to about 5% CAGR, and then our bull case assumption even less than that, down to about a 3.5% CAGR for the pricing level of the residential products over this time, which brings us up to over 9,000 per average weighted product in 2032, 8,000 for the base case, 7.2 thousand for the bull case. Again, it might seem counterintuitive to have a lower growth rate for the bull case assumption, but I think given the dynamics of these particular discretionary products, it makes sense to me. Then switching gears to take a look at the commercial and industrial as well as the other revenues, I did something slightly different for the commercial and industrial. Rather than comparing it to the households acquired, I actually took a measure of the commercial industrial revenues compared to the total amount of households that have been acquired instead of the individual acquisitions. The reason why I did this is that because of the fact that I don't have some specific measures of penetration within the industrial market, I didn't want to make assumptions about how those are going to change the growth of their relative amounts over time. And instead, I just wanted to say that for each household that has been penetrated by Generac products, that incentivizes industrial and commercial applications of their usage just by the products becoming more well known and the company themselves becoming more well known. So we can see a ratio of these revenues over time moving kind of from around the 100 levels, 80s, 70s levels, then back up into 90s, 60s. You can see it's a little bit more up and down and chaotic over time with this metric, even though we're still relying, like I said, on a 2-year average of the households to try to smooth out some of these effects. Either way, over the 10-year period, we end up with an average of about $87 weighted per household for the commercial and industrial revenues, and we're going to use that as our basis moving forward. For the growth of these particular revenues per household for the commercial industrial products, I'm having them grow at approximately half the rate of growth of the household pricing levels, and I do that consistently for each of these models. So I'm just simply having them grow at a much slower rate relative to the household products, because I'm going to assume that the industrial and commercial applications will probably have relatively stronger ability to fight back against the pricing power. I do think that this method of building up the revenues for commercial industrial is kind of inherently more conservative, especially considering the commercial industrial applications have actually had a bit of a faster growth rate over the last few years relative to residential. So it's possible that I'm significantly underestimating the growth of commercial industrial with this methodology. I use approximately a similar method for the other revenues as well, taking essentially a ratio of the revenues of the total amount of households rather than the acquisitions of the households, which gets us to an assumption But we can see that it doesn't quite have the same pattern as the commercial industrial growth, wherein these ones do show a little bit more of a consistent growth over time, solidly getting up out of the 20s into the 30s when we enter the more inflationary period, even into the 40s. So we can perhaps expect a little bit more of a consistent growth of the relative pricing of these products relative to the commercial industrial or even the residential. So likewise, it grew at about 6% per year for the historical period that we had. And since I don't really have too much internal insight into the particular types of products that these are being used for, these are mostly just service products relative to the other segments. I'm going to allow all three of our cases to just grow at the 6%, since it's basically just the smallest portion of the company itself as is. So all in together, these assumptions combine to give us residential revenues for our bear case assumption of about 2.6 billion, our base case assumption about 3.5, 3.6 billion, and our bull case assumption about 5.2 billion. And then that also gets us commercial and industrial revenues of about 1.4 billion, 1.5 billion, and 1.7, 1.8 billion, with other revenues of about 870 million, 1 billion, and 1.2 to 1.3 billion, all of which combine together to domestic revenues of just under 5 billion, just over 6 billion, and a significant amount over 8 billion in 2032. Now, obviously, that's still just the domestic part of the business. We still have the international portion of the business. I chose to use a somewhat similar method for international as I was taking with the commercial, industrial, and other, which is essentially just to take a ratio of the domestic relative to international and see how that changed over time. You can see that over the historic period, the average was about 20% relative to that, with some upward and downward movements over time. So I decided to just rely on that longer term average. And I decided in each of my three cases to not alter that particular ratio to any significant level, because the portion of international to domestic was small enough that I figured I should just leave that ratio as is. Not to mention, frankly, I'm a little bit more bullish on these thematic elements that makes me build this case for this revenue model more focused on the US markets than I am on international to begin with. So 20% across the board gets us just under 1 billion for the bear case assumption, 1.2 billion for the base case assumption, and 1.6 billion for the bull case assumption. All in together, these combine to get us about 5.9 billion as our bear case, 7.2 to 7.3 for our base case, and about 9.9 billion for our bull case assumption. So coming around to take a look at our valuation template here on the revenue page, you can see for our bull, base, and bear case assumptions in the final year, I have the numbers approximately in the ballpark of where our model got us to. The bull case is a little bit lower, and the base and bear cases are a little bit higher, so approximately kind of gets us in that ballpark. I do have it tilted a little bit more towards the optimistic end, because I am definitely a little bit more optimistic on this company, and I even still think that I made the case for like the penetration rates that I use perhaps being significantly lower, and for some of the pricing assumptions perhaps being significantly lower than what we might be able to expect too. So I think that there's plenty of reason to believe that you can be optimistic on the revenues in this company. In the short term, I am relying mostly on the analyst assumptions for the next 3 years, allowing my assumptions to essentially be a little bit lower generally than what the analysts assume. And then from that point, I just move towards my terminal numbers that I assume. Coming down here, you can take a look at the cumulative growth cases on the chart. As you can see, generally, we're expecting more than 50%, if not more than 100% of revenue growth over the next decade. And like I said, I still think I'm leaving plenty of icing off the cake for this one. Coming over to take a look at margins, it's one thing to take into account for this company, as I kind of mentioned earlier, is that this company does do a significant amount of R&D. So my operating margin assumptions are likely to be about 1 to 2% higher than a GAAP operating margin assumption that you happen to take a look at. So keep that in mind if you're hearing the percentages I say and you think that sounds slightly off from what operating margin you might be looking at. But similarly, with the revenues in the short run, I have my assumptions somewhat in line with what the analyst expectations seem to be seeing, at least in terms of the nominal amount of operating income, not necessarily the percentage itself. But in the short run, we have operating margin assumptions of approximately 15.7% for the next 5 years. The 5 years following that, we have an average margin of around 18%, which then is going to be killing down in the terminal year towards about 16.9%. That compared to the approximate 17% average operating margin that I saw over the 10 years prior. So that's kind of where I'm getting these assumptions from, allowing it to be a little bit lower in the short run as we're expecting some lower profitability and then kind of a bounce back towards the terminal period overall. Coming down here, you can see the disbursement of the probabilities as I have it. You can see in the short run, I have a pretty high amount of uncertainty as far as what that operating margin is going to be. And then I do feel pretty strongly that they will have a period of high profitability due to the high demand for their products at some point in the interim period, which will then tailor off towards lower profitability in the terminal year as expected. If we take a look at the operating income distribution over here, you can see that the kind of modal median outcome is somewhere between 1.2 to 1.4 billion in 2032. Then coming over to take a look at capital investment, we can see that the returns on invested capital that I'm projecting for the first 5 years is about 14%. The 5 years following that, about 17%, and then ending the terminal year about 15.9%. So very, very strong returns on invested capital still being expected. The net reinvestment as a percentage of sales over the interim period definitely fluctuates, but in the terminal year, it ends up around, I believe, 4% as a percentage of sales, netted, of course, of depreciation and amortization. And likewise, over the interim period, that also accounts for the R&D costs, as I was saying, amortized. Coming down to take a look at the graphs, you can see the returns on invested capital projected on different cases over time, capital investment, and also the free cash flow distribution in the terminal year, with the majority of the expected cases of free cash flow, as you can see, somewhere between 650 and maybe 850 million overall. And then taking a look at the expected outcomes, you can see with applying a set of terminal assumptions that get us an implied terminal multiple distribution, as you can see here, that gets us an expected fair value today of about $125.28. Expected returns, if you were to buy it today, at about 10.4%. With a distribution of outcomes that say that the current value, if you were to buy it today and the value was of anywhere between $103 and $144, actually, then that would mean that you could possibly expect to get, based off of the price today, between 8.3% and 11.9% in expected returns, meaning that it would be anywhere from 11% overvalued to 23% undervalued based off of your purchase. You can see the distribution of those outcomes, as you can see here. Majority of those outcomes, again, between about $100 and $140 or so. Majority of the returns between about 8 and 12%. And then coming over to the final page, you can see a summary of the expected cases for each of these assumptions displayed in a more traditional form, with the current percentile of the value distribution that it's currently trading at of about 41%. As I said, that means we can expect about 10.4 expected returns each year over the next 10 years. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. That's going to do it for our valuation of Generac, ticker GNRC. I'm very, very interested in this company, but given that it is currently at fair value and the cyclical nature of its products, I'm not necessarily in a super rush to be going out and making a huge position in it today. If we get a significant pullback in this company, you can assume that I will be adding it to my portfolio though. I'll catch you all in the next valuation. Bye.